Hello and welcome to today's Delta Credit Tip. So you've got this big bill coming, some big large expense. You want to buy a home, you want to pay off some credit card debt, maybe a medical expense, something's going on and you need to come up with a lot of money really fast. And you get the idea of, well, I do have $10,000 in my 401k. Should I take the money out? What are the benefits to it? What are some of the pitfalls? Stay tuned, we'll fill you in on today's Delta Credit Tip. Hello and welcome back to today's Delta Credit Tip. So today we're talking about 401k distributions. Should you do it? Should you not do it? You know, you've got this big financial obstacle coming your way. You want to start a business, you want to buy a home, you need to pay off some credit cards, whatever the case may be, right? The 401k is typically one of the only places that we can save money in both good and bad times because we don't see the money, right? We adjust our budgets to our after-tax net income and we just kind of live with it, right? So 401ks are typically a very good target for large dollar transactions that we don't typically have the money for. So today we're going to talk some of the benefits and some of the consequences that you may want to consider when doing 401k options, okay? Or, at least 401k distributions. Now at the end, we're going to talk about something that you may want to consider that can help kind of offset some of those pros and cons and make it an easier decision or at least an easier thing to do. So stay tuned for that near the end. And in the meantime, if the information is helpful, please give us a thumbs up, subscribe below so that you get information as it comes out, and don't forget to hit the bell so that you can be reminded. Most importantly, don't forget to share the information. This is how we stay informed. This is how we make good financial decisions. And this is the whole point of the YouTube channel so that we can make a choice, make a change here at Delta. So let's talk about a 401k distribution. All right. Now let me preface this by saying that this is not investment advice. We're not talking about how are you going to invest your money as an investment tool. We're not going to talk taxes either as it's specific to you, right? You need to talk to your tax advisor about that. And also what we would recommend is that you talk to your plan administrator. For every 401k, there should be someone assigned to that because that person is getting paid for selling it to your company, right? And that person's job is to administer that so that you, the employee, understands all the ins and outs and bells and whistles of that plan. What we're talking about is how does this affect your credit? So if your knee-jerk reaction to what I just said was, what does he mean? How does that affect my credit? It has nothing to do with my credit report. It has nothing to do with my credit score. Well, then you need to go back and watch some of our other videos. Remember, your credit is not a score. Your credit is a financial behavior that leads to your score. Credit repair is not about just fixing stuff on the back end when things get messed up. It's about making the right financial decisions going into these relationships that we have, okay? So really what we want to talk about now is, okay, how do we first get this money out of the 401k? And again, what are some of the pros? What are some of the cons? So the first way that you can get money out of a 401k is with a loan, okay? Now you can take your money out as a loan, which means of course you've got to pay it back. And that's kind of one of the benefits to this is that you're borrowing money from yourself. One, it's a very easy loan to get because I kind of like me as a person and I think I'm going to go ahead and let that go through, right? And it doesn't come from a quote-unquote lender. It comes from your 401k, right? So it's a pretty much guaranteed loan, right? And the interest that you pay, you typically pay yourself back. Now, again, you want to talk to your plan administrator. They're going to tell you all the ins and outs of how that works, right? But that's really the big benefit. In times of crisis, you can pull that money out, put it back in. Sometimes you can keep contributing to it. Sometimes you can't. All that stuff your plan administrator can tell you. But lending yourself the money is a great benefit, which just so happens to be one of the pitfalls to it. You are still borrowing the money, which means you still have to pay it back. And while the interest may be going to you, you don't have access to it. So it's just like paying somebody else. So it's taking even more money out of your everyday paycheck than you put into it, or than you got out of it at the time. You know what I'm saying? You're basically paying more than what you borrowed, right? Which means more money out of your pocket. And ultimately what that means is that it's affecting your net income. Okay? And that net income is important. We have found that most people make between 78 and 81% of their gross income. Sometimes 77, sometimes 83, right? Depending on the number of deductions. But the average person makes that. Once you take that 401k loan, you have slashed your net income significantly, because this is after-tax money, right? You're paying money out of your check, and it's really, really lowering your net income per month, which also affects your debt to income ratio. If you have any debts left over after you take that distribution, then the debts that you're paying are a higher percentage of your income, because now you're actually getting paid less per check. So it makes you less lendable. So even if you're taking that money out as a down payment for your home, you got to be careful, because you can mess your loan up on the income side of the loan, of the qualification. So that 401k loan, although it's going back and you're earning your own interest, it does a number on you financially from paycheck to paycheck. And that's the biggest fault that I find with it. Okay. So now let's say we're not going to do the loan. We're just going to take the money out, one-time distribution, not paying it back, whatever the case may be. Okay. So now really the cons to this, right? The downside to this is that usually there's a huge tax penalty, and there's also, not a tax penalty, there's a tax consequence, and then there's a penalty on top of that tax consequence. Okay. Again, talk to your plan administrator, talk to your tax advisor as to what specifically those consequences for you and your specific plan will be. But this is it's a huge part of making this decision, because it is typically a very large sum of money that you're going to have to pay. But on top of that, you're also going to have to pay what we call opportunity cost. See, let's say you're 30 years old, right? And you've got $10,000 sitting in a 401k, and you want to take that money out to buy a home. Okay. Well, the thing is that by the time you actually retire, if that money was still in that account, making a modest, say, 6% interest rate, right? That could be $30,000, $40,000 by the time you actually get to the point of retirement. So you're not spending $10,000. You're spending $10,000 plus an additional potential $30,000 plus more that you just simply won't realize because you took that money out. Right? And even as a loan, if it takes you 2, 3, 4, 5 years to pay off that loan, it still is going to decrease the amount of time that you have that money invested, thus your yield. So now, just in case this video just made you go, I never thought about that. I need to put money in my 401k so I can take it out later on, right? In case I need it. It's actually a great plan, but there's some advice that we might want to give you that may make that a little less painful. Okay, if you're going to start contributing money to your 401k, or if your annual enrollment is coming up, you may want to ask your plan administrator about an after-tax option. Usually when you put money in a 401k, it's going to be a pre-tax dollars that you put in, so you haven't paid taxes on it, but you're putting it in there. But there's sometimes an opportunity for an after-tax option. And the consequences typically on taking that money out of a 401k are dramatically different. Okay, that's what I did when I was in corporate America. You know, I had half my money going to a pre-tax option, half of my money going to a post-tax option, and that post-tax tax option gave me a little bit more flexibility in that plan. Okay, so hopefully that information will help. If so, again, please give it a thumbs up, right? Subscribe below, hit the bell so that every Thursday as we come out with new information, you can inform yourself, help us by informing others, by sharing it, but most importantly, make a choice, make a change, Delta.